Korea's economic growth has been slowing down in recent months with a sudden drop in exports. Here's something to help ease that concern. The nation's foreign exchange reserves hit a landmark figure in June. Soo-young explains further.
South Korea's foreign exchange reserves topped $400 billion for the first time in June, bolstering the country's financial stability. The Bank of Korea said Wednesday the country's reserves grew $1.3 billion from the previous month to $400.3 billion. The record-breaking figure comes more than 7 years after the country's foreign reserves passed the $300 billion threshold in 2011. It is also 100 times larger than the reserves of just $4 billion back in 1997 during the Asian financial crisis. A bank official said the recent surge was largely due to a steady current account surplus and also cited constant gains in assets held in foreign currencies. Securities holdings alone reached $367 billion, up by $1.56 billion on month. Amid concerns of a downturn in exports, consumption and investment, experts say the country's burgeoning foreign reserves are an encouraging sign of financial resilience, as they translate to a growing ability to service foreign debt. South Korea's short-term external debt in 1997 was roughly 3 times its foreign exchange reserves. The ratio came to 75% during the global financial crisis and fell to just 30.4% in March this year.
We have more than enough foreign reserves to pay back all the short-term debt should the short-term investors and lenders from overseas would want their dollar back. If the investors have confidence that Korea has enough dollars to pay them back, then paradoxically, they're less liable to ask for their money back.
However, the expert says the country shouldn't grow complacent, but rather work to maintain the right balance of foreign reserves in the vault.
There's sort of an ideal level where there's enough insurance to guard against currency crisis, but also not excessive reserves so that the government has enough money to make welfare payments, build infrastructure, and so on. Having a lot of foreign currency reserves do make Korean government more vulnerable to changes in exchange rates. When the dollar strengthens, it's good for the Bank of Korea because their assets go up, but if the dollar weakens, then it's bad for Bank of Korea because the value of their assets go down.
Some experts are also concerned that there may be limits to increasing foreign currency holdings when Korea begins disclosing its market intervention records next year, following pressure from the US and the IMF, so as to avoid being labelled as a currency manipulator. Soo-young, Arirang News.